Laijawala now joins us, Head of India Research at Deutsche Equities. Abhay, good morning. Always good to have you. Your first thoughts on the union budget and the market's reaction. Of course, we have the global cues to deal with as well. But yesterday we had a 500-point rally in the Sensex. Your thoughts?
So the market reaction was largely attributed to, I guess, a relief that, we did not have many of the fears, particularly the capital gains tax not coming through. In addition, there had been a lot of worry that ahead of, the state elections as well as the national election, there would be probably a lot of handouts, the possibility of subsidies. These did not come through. There was worry that service taxes would be raised to align with the GST rates. Even these did not come through. So in that sense, ironically, the market moved up because of what was not in the budget rather than anything very specific in the budget. Overall, we think that the budget was positive. Clearly, the finance minister has balanced all the compulsions very well. And I think the standout has been fiscal consolidation. This is the third consecutive budget where the government has desisted any pressure on, on growing the fiscal deficit. And there was huge pressure. In fact, after demonetization this year as well, there was huge pressure to stretch the fisc, but we've stayed on the fiscal consolidation path. And I think this is something that international investors as well as the global rating agencies will be viewing very, very credibly.
Okay. Well, Abhay, let's discuss sectors and stocks. The markets also run up a goodish bit. Is there still earnings growth that is not already in the price? If yes, where?
So, Lata, the market has moved up. I think we've seen a rather surprising move up in the market in the last 2 to 3 weeks. And once again, the market has moved up on the back of a PE expansion. There is unfortunately no catalyst which suggests that earnings growth expectations have improved. So it's been a combination of domestic liquidity, to some extent foreign liquidity, with the recent depreciation of the US dollar, as well as some relief on global bond yields. And of course, domestic liquidity here in India. But unfortunately, there is nothing to suggest an earnings recovery or any shift in that right now.
Okay, the stock that's surging now is ICICI Bank, and actually that's taking the bank nifty also higher. Abhay, your thoughts on how to build portfolio here? Because we have a bipolar market. IT and pharma not doing well, but banks more than compensating. Consumption has started to do well again. NBFCs are doing well. So from here on, what will be the large sectoral bets?
So I think clearly after the budget and in the run-up to the credit policy, we do think that the banks should be doing very well because after yesterday's budget, the thrust on fiscal consolidation and with no guidance from the Fed yesterday on a forewarning on rate increases next month, a rate cut by the Reserve Bank of India is firmly back on the table. So we do think that in the run-up to the credit policy, banks as well as select consumer discretionaries and of course the NBFCs should be doing very well. As far as banks are concerned, our banks analysts are very positive on the wholesale funded banks at this point in time. And I think those banks should obviously be doing very well together with the NBFCs. As far as consumer discretionary goes, we think that auto companies stand to benefit impressively. And clearly with interest rates in the country already at consumer finance interest rates already at an 8-year low, the expectation of further decline in consumer finance rates should be buoying up the consumer discretionary stocks. And on IT, we are contrarian. We believe that the market is worried or is excessively worried over the H-1B visa-related issues. Now, the worries are legitimate, we concede that, but the market is giving absolutely paying no attention to the revenue side of the equation. The global banking and financial services sector constitutes close to 40 to 45% of the revenues of Indian IT companies. And after a gap of 2 to 3 years, we are seeing the prospect of a lesser regulation, particularly in the United States, for the banks. In addition, the yield curve is steepening, NIMs are set to return. And all of this should mean that a lot of the discretionary IT spending which has been held back will start coming back. Our IT analyst remains positive, and he believes that constant currency revenue growth for the IT companies should be moving back to 10 to 11% in FY18 relative to what we've seen last year. So we are contrarians in IT. And the other sector we like right now, and we continue to like, is the oil and gas sector, where we like the oil refiners and the gas companies.
Okay, well, Abhay, is there anything for you to increase your Sensex target further? I think you all had set it at 29,000. Is there now space to even increase it further? Now we're almost there.
We've said in our outlook that 2017 is going to be a year of uncertainties. And we had also said over there that, in the first quarter of the year, the markets will be volatile. So that is our view, and we believe that we really need to, have a lot more certainty before we can conclude that a sustainable run in the markets lies ahead of us. So we are maintaining our target. We see no reason to believe that the uncertainties that we expect have gone away, and we'll have to watch how things go.
Point entirely, actually. A lot of people will be skeptical about the kind of consensus earnings that are out there for FY18, but let's see how things pan out.